Hi, everyone. Welcome to CoMotion Lab's Fundamentals for Startups. My name is Alea Liano, Community Coordinator here at Startup Hall. For those of you that are new to us, CoMotion Labs provides a multi-industry lab system hosting startups inside and out. The UW community in life science, hardware, startup and IT, fintech, and many more. Our startups range from pre-seed to Series A, employing about 2 to 15 people each, variously headed by students, faculty, and community leaders, with both new and seasoned entrepreneur represented. While we wait for everyone to log in, I'll make a few announcements. Next week, Lean Kawa, CEO of Athera Pharma, will present The Long Run, creating a life science startup. Dr. Kawas was recently named Life Sciences Executive of the Year by the Puget Sound Business Journal and was featured in Encyclopedia Britannica's list of 20 under 40 young shapers of the future in health and medicine. All of our fundamentals for startups presentations are archived on our CoMotion website under Labs, Startup Training Videos. There are a variety of topics over the past several years, so if you find yourself with some free time, check those out. For the full schedule and to register for future fundamentals, please visit comotion.uw.edu/events. Also, please subscribe to our YouTube channel and click the little bell to be notified of all future live streams. Finally, Fundamentals for Startup is funded in part by a grant from the Economic Development Agency. We will be dropping a link into the chat for a short survey. Please tell us who you are, where you're watching, and how you heard about this event. This will help us report back to continue the funding. This year, we are proud to partner with Bluetooth to support the Fundamentals for Startups program. See how Bluetooth audio sharing is poised to once again change the way you will experience audio and connect with the world around you.
Bluetooth introduced the world to wireless audio. Calling, listening, watching, making us safer, more productive, more joyful. It's part of the fabric of our lives. Now, Bluetooth will bring us even closer to each other and our world with audio sharing. It will let us share with others our music, our experiences, listening and watching together. The places we go will share with us, enriching our experiences, helping us hear our world. Breaking down barriers between interests, cultures, generations. Introducing Bluetooth audio sharing. Closer together.
Today, Kathleen Baxley, founder of Startup Valuation Resources, will present Business Model Fundamentals. Kathleen is a seasoned investment professional and founder who now provides interim CFO services to help entrepreneurs make a little more compelling and professionally formatted case for early stage investments in their businesses. Kathleen has more than 25 years of experience as an equity analyst, preparing financial models, business plans, marketing analysis, and valuation tools. She has made investment recommendations to the global equity desk based on fundamental performance, strategies, events, trends, and their impact on company valuations. Kathleen will take all questions via YouTube chat. Feel free to ask questions throughout the presentation. Thank you so much for being here. And now I will turn the event over to Kathleen.
Good morning, everyone. I'm happy to be here and hope this is helpful to you all as you do your financial planning. As Alea said, I've been doing modeling for lots of years and lots of different circumstances, and have got a lot of experience, particularly in startups and helping them figure out how to tell their story. So talking about, well, what is a financial model? It is the story of how you make money. You have your product story, your strategy, and this is how you get to the profit. It is not a prediction of the future, but it is your best guess. And so if it's not a prediction of the future, why do you do it? Well, it helps you to make better financial decisions and anticipate what you're going to need before you need it, so that you're not scrambling at the last minute to raise capital. It also gets into depth about the inner workings of your company and how all the different parts and decisions interact with each other, and allows you to kind of do scenario testing. Well, what if I change my pricing? What if I do this? What if I do that? And most importantly, it makes sure you have enough cash in the bank to pay your bills. So one of the key purposes of a financial model is also to communicate to others how your business works. And it's kind of a mechanical walkthrough of all the decisions that have to be made. And so if you're an investor, you get a stack of company ideas every month that's, you know, very big. They don't have the time to go through every company's model to dig in, you know, how did they get there? What was this assumption? They want things in an easy format where they can just look at it and understand what's going on. And there is a format that everybody follows, so that they don't have to reinvent the wheel, and they can compare across companies. If your model is not clear or hard to understand, there is another company right below you in the stack that they'll move on to. So the modeling part of it for them is a screening tool that is comparable across companies, so that they can make their decision on, you know, which company best meets their investment criteria. So this is just important to remember, that no matter how cool the product is, it's not a business that people won't pay you. And what the model does is it follows the money through your business and tells that story. One of the most important things that people sometimes don't take into account is your profit and loss statement tells you, here's how many things I sold, here's how much it cost to make them, and here's how much profit I made on those units. That doesn't take into consideration that the cash that goes through the business doesn't always come all in one month. In fact, it hardly ever does. So with different kinds of business models, you have to take things into consideration. So product sales, you've got inventory that you have to pay for. There's timing issues. Subscription sales, you know, when do you get paid? Is it monthly? Is it annual? What's the renewal rate, and how much is dropping off each month? Oops. And then with licensing, there are also timing issues associated with how the cash comes in the door. And you need to reflect all of that in the model, because that's really what's going to determine your survival. So this is just kind of an example of the issue with cash flow. So each month you get some development expenses, they're getting bigger and then they're stabilizing. You've got some sales expenses, they're getting bigger and they will continue to get bigger. But your revenue comes later. So you are losing. And then at some point, this is 36 months, so, you know, maybe it's 2.5 years out, your trend line starts to change. So what you need to be thinking about when you're doing the model is, well, how much cash am I going to need? So something, I'm getting some weird feedback. Anyway, so you want to raise enough money so that you don't run out. If you're raising for 24 months or 18 months, let's say, you'll be about here. Oops, how do I go back? Okay. You'll be about here. And then you'll go for your next raise and get down and get back up. So this is to help you both understand for yourself and communicate to an investor how the cash is going to flow and that you are asking for the right amount of money. So when I'm doing a model with a client, I usually start with a lean canvas. I'm not going to go into the details on this right now because it's kind of its own separate exercise, but this helps me to think about, well, what are the different parts? You know, what are the metrics? What is my product? Who's going to buy it? All that kind of stuff. And from all of this information on the top, you can glean the information that you need on the bottom. What's your revenue and what's your expenses? So first, I wanted to just kind of run through some best practices that I pretty much stick to. And I think it's good to have one discipline of like, okay, this is how I do it. You know, January of 2021 is always column H. Tab named SAS Subscriptions is where I go for the SAS subscription stuff. But so first you map out the first 24 months and you have some visibility as to what's going to happen there. So that's, you can get into, there's more certainty. And then years 3 through 5, I usually do 5 years. You take that and you project from it. During those first 2 years, you're looking for product market fit, you're doing some experimentation, and you know, results are going to be lumpy, but that's where you get to the place where you have a trend line in the end. So you're testing what works, what doesn't. Guess what? Do more of what works. And you're building your knowledge base about your customers and figuring out what is that sales formula that's going to work for me going forward. So those are some do's. Here are some don'ts. It should be clear in your document like what assumptions you're using, where they are, how they interact with other things. Frequently, I see people put numbers in that are actually assumptions, and they call them fact. You know, what's your customer acquisition cost? Well, that is a function of spend and response rate. So it should be an output, not an input. And if you put a lot of plug numbers in there, you're really limiting your ability to use it as a tool going forward, because you have to go in and manually recount things, and that is just a recipe for mistakes. And there should be a logic. It is telling a story. First this happens, and then this happens, and then this happens. Most models I see do not have cash flow and balance sheet, and I would argue that the cash flow is probably the most important thing. You know, and having clear assumptions allows you to easily change scenarios. So it actually becomes a real working tool for you. So here are some of the conventions. These are two completely different models, but you'll notice similarities. They've got the months across the top. They've got expenses and revenues and things like that down the side. I usually do a separate tab for each source of income. And you'll see that when we go into the model that I'm going to go through with you. Separate tabs for each of the different major expense categories, full financial statements, and then summaries and performance indicators. So let's walk through a sample model. So across the bottom here, you'll see product, SaaS, and licensing. So I just kind of walked through the economics of each one of these. Then your customer acquisition cost and your customer lifetime value, which are ways to understand how your growth is going to progress. So first, looking at a product model, you manufacture some stuff, you sell some portion of what you've manufactured, and you sell some units. So if you look here, I manufactured 200. I'm assuming that there's a 1 month lag during which the thing is put together and when it's sold. So you make them here, you sell 10% here, and you're building up your inventory, which is just how many you made versus how many you sold. Each month, your inventory is building. I'm going to send you these spreadsheets, by the way, so you will have all the formulas, but I've also noted down the side here what the formulas are. So each month you're making some and you're selling some, but you have to make them in advance. So you got to figure out what the implications of that are. And when you sell them, you might not get paid in the first month. So you've sold 200 here at $1. Oh no, I'm sorry. You sold 20 here at $2 each. But the $10 each, I'm sorry. So you sold 20 units at $10. Those units that you sold, those 20 units, cost $2 each to make. But so that's looking at it all in the month of transaction. In reality, what will happen is you don't get paid until later. But you have to put out the money up front. So what I'm assuming here is sales happen 1 month, payment happens 1 month after the sale, manufacturing happens before the sale, 1 month. So each month you are adding to your revenue or to your inventory, and you're taking some stuff out that you sold, which gives you the change in your inventory. But your inventory is building, and it has to build because next month's sales are going to be bigger than last month. So, the conundrum here is that you need to have inventory to run the business, but the money that you're spending on inventory is money that you can't use for growth. So you want to be as close on your inventory as you can without disrupting the flow of your business. For the SaaS model, it's different. Usually if it's an enterprise SaaS company, you're going to have sales reps. Assume that you hire a certain number of reps, and each rep can bring in a certain number of accounts. These numbers are not realistic, but they're just for explanatory purposes. So you have 2 reps that each brought in 15. And kind of like the concept of inventory, you are building a base of subscribers, which is the beauty of the SaaS model, is that you have repeat business that you don't have to go sell new every month. So for example, here you start with 20 subscribers that you brought in, and nobody drops off because they're brand new. Start with 5, and you have 5 in inventory. Then next month you have 20. Some of them drop off. It's a small number. So you still have essentially 20, and your accounts are the 5 plus the 20. So this is what you're adding to the pool each month, and this is how big the pool is. So subscription economics have some particular characteristics to them, mostly around when you get paid. So you may have your subscriptions be paid monthly, or you might have people pay you a year up front. Obviously, it's nicer to get the money up front if you can, but that's going to kind of depend on the competitive landscape. So looking above at the subscriptions that were sold, you get your 520 new sales and total base. So I'm just pulling these numbers down here so we can see them.
Hey, Kathleen, we got a little alert on your screen share that's saying that your battery was low. I just want to make sure that you're all plugged in.
Oh, thank you.
Yeah.
And in fact, I am plugged in.
Perfect. Awesome. That's it. Thank
Okay.
you.
Yeah, so you're building your subscriber base. You've got people who are new coming on, and you've got people who are the total base of everybody that's on. So if you're billed monthly, here we're going to say $1,000 a month, then your payment is very straightforward. You've got 25 active users, and you've got $1,000. So that should be $25,000. And it is. This is rounding. So that's how your revenue builds. It's very straightforward. How many members do you have and what do you charge them? If you are charging annually, it's a different set of economics. So this is the same subscription, looking at it as annual payments. So you receive $12,000 each year. Here, you're going to receive 12,000 times the 5 new users. Here, 12,000 times 5. And each month it's the same. Your revenue is going to be how many subscriptions did you deliver in that month? How many subscribers for the month? So every subscriber is essentially paying you $1,000 a month. So it looks like so from a revenue perspective, you're getting $5,000 in revenue for what you sold in that period. Then your cash payments are going to be the full amount for the 5 people that you added, because you're receiving that cash. So how do you reconcile the fact that you have this extra $55,000 in cash that you've received that you haven't effectively delivered to the customer? Each month for this group, it's 5,000, but you got all this cash. Well, it's nice to get that cash, but you have to account for it on the balance sheet. So you have prepaid revenue. They've paid you in advance for services that you're going to deliver later. And each month, the prepaid revenue amount grows because you're receiving more and more cash. So the prepaid revenue account is going to look like all the new cash we received for subscriptions, new subscriptions, minus the monthly amount for the monthly subscriptions delivered. Over here, you can see I've put all the math in here, so you can go into it when you're on your own and see what's done there. Looking at licensing, it's very similar to subscription sales, but it has multiple components to it. So again, you have sales reps that are bringing on new accounts. So that's how many accounts were sold. You have the number that you sold minus churn, which is going to be 5% of everything that was on the books at the start of the month, or at the end of last month. Your total active accounts, just like with the other one, is going to be the 20 that you brought on plus the 5 that were already on from last month. Licensing revenue usually has 3 parts to it. You may use some or all of them, but one is a setup fee for bringing them on board and doing whatever customization needs to be done on their end. Then you have a monthly user fee. And then you make an assumption about some level of upselling that's going to happen in the future. So looking at this same base of subscribers, typically if it's a software that's going to be used by employees, you have a number of accounts, but you're also making an assumption that each account has a certain number of users. In this case, 500. So as you're bringing on the new accounts, you also are bringing on new users. So on the fee side, you've got $1,000 for each new account that's brought on and $100 for each user in that month, and then the upsell. So your total revenue looks like this. Then, okay, so what's my customer acquisition cost? Customer acquisition cost is important because it's something that you can measure against the profitability of each unit. So it's always unit based. So how much did you spend on marketing? This is looking at internet sales. So how much did you spend on marketing? How many clicks came through? How many conversions? So you got 71 orders out of that 30,000. So, then what did it cost you? Well, it cost you the 30,000, but you also had 10,000 of other miscellaneous costs. And everything goes into the customer acquisition cost. It's not just how much did I spend on Google Ads. It's what was my total marketing expense to bring in those orders. So marketing salaries, promo stuff, all of that goes into it. So you have your total marketing spend. Yeah, this is these two things together. And then this is how much did you spend divided by how many orders. Looking at a Salesforce model, you have a number of salespeople, and I'm just using the SAS model that we'd gone through before. So I'm pulling the assumptions there, and I'm pulling the account sales. You had to hire people. Each person is $100,000 a year. So in a given month, it's going to be one person times 120 divided by 12 because you're looking at the monthly salary. So here you've added people, you've added, and so your salaries are going to grow. What that means is, particularly because there's a timing lag between when you bring somebody on and when you actually start seeing business, if you have a long sales cycle, that's all time you're going to be paying those people, but you're not going to be seeing revenue. So you have to factor that in. Then you have some other sales costs and total sales and marketing, which is just the 40 plus the 5. So your customer acquisition cost you will see goes down. You hear okay? So you have your customer acquisition cost. In the beginning, you're trying all kinds of things. You don't know what's going to work. So you're kind of throwing money at a wall and seeing what sticks. Again, as you start to learn what's working, you do more of what's working and less of what's not. And you start to refine your sales process so that eventually this number starts to look pretty consistent. But in the early stages, it's going to be, it's going to be all over the place. And that's to be expected. What really matters is as you start to mature as a company, where does it end up over time? Customer acquisition cost builds on the revenue and the customer acquisition cost. What you want to know is for every new user that I bring in, how much goes to the bottom line. So you know your revenue per, your revenue per month is 1,000. Again, just using from the other model. You have 25 customers. If you have a 5% attrition rate, then your churn rate is going to be 1 over 0.5. Works out mathematically. But you can walk through that on your own. So we're saying $1,000 a month. If 5% drops off every month, then that's 20 months of life of that subscription. So the lifetime revenue is going to be revenue per member times the term. Customer acquisition cost. We're going to pull from this other page. I'm using the SAS number. So here's how much revenue comes in over the life of the subscription. Here's how much it costs to bring them in. Oh, by the way, you have to deliver the product. So your model will tell you what you think that the gross margin is going to be. So you want to say, well, in the beginning, it's going to be all over the place. But if I'm thinking about this company and I'm really interested in like, what is the long-term potential? I can say, all right, well, my average gross margin once I'm up and running is about 80%. So that's my gross margin. So you make 20,000 in revenue per unit. You have gross profit of 16,000 after you take away the cost of goods. And then your customer acquisition cost is how much it costs you to bring that member in. And there's your lifetime value. So that is some of the mechanics of the models. Oops. So the thing to remember is that this is a tool. It's not telling people what's going to be happening. And so as you gain experience, you're going to start to know what some of those assumptions were. You know, what is your click rate, or how many orders can a typical rep bring in a typical month? You're always monitoring those drivers and adapting as time goes on. So, you know, clearly the thing that we thought it was going to be a year ago, it's hopefully better, and change your assumptions, and everything else in the model will flow out based on those new assumptions. You want to look at, well, what is my best case? What is my worst case? You want to present a very strong case to investors. Again, you want to be able to play with it. You know, what happens if I do this? And these are guesses, really. So there's some things that you know today. There are some kinds of relationships between things that you know today. What we want to do today is set it up so that as you get more information on those things, you can input them. And it is not a, I'm going to do this because I'm raising money right now. It's a tool that you use all the time to help you understand how your business decisions are impacting your bottom line. This is just a list of some resources where you can find models, templates, discussion of all that stuff. Again, you'll get these from the slides. So that is the prepared part of my discussion, and wanted to see, do you have any questions?
I have a question. So as you add new salespeople, how do you account for individual performance in the model?
So you're going to see, you're going to see maturity of salespeople as time goes on. So you add a person now, hopefully they are way more productive 6 months from now. So and then when you bring the new person on, they're going to start at 0 and go up. So what you want to do is create kind of a weighted average of productivity based on how many new people versus how many you had to start with. Kind of like that idea of inventory. You have mature salespeople who are growing at a certain rate, and then you're folding in new people, and your production goes down temporarily until those other people get to the maturity point of the mature reps.
All right. And I have another question from Shane C. You mentioned the lean canvas. Are there any other tools or resources you recommend to help startups learn about their financial models?
I would go to the list of sites that I put in here, which you will have. And those are somewhere like they have templates, they have explanation, they give a lot of information. And you know, if you have something that you don't understand, call me.
All right. Do you have a favorite of those out of those lists?
Well, yes, Alexander Jarvis. If you look at his site, he's very funny and irreverent and kind of cheeky. He's a Brit. So he actually is very knowledgeable, but he's also kind of fun to read.
All right. Let's see. From Tian Yu, if the project is like an app and profit only comes from ad, does that make the business model easier?
It makes it simpler, but it's harder to sell. Meaning you have to build up a really meaningful base of users before your ads are going to start to mean anything. And advertising is very, very competitive. So you're kind of putting all your eggs in one basket. So from an outsider's perspective, looking at your company, if you have an app that's worth having, why aren't you charging? Why won't people pay you?
Right.
So it's better to have both.
For sure. Here's another question. Brandon, so outside of the lean canvas, are the business model and financial model / cash flow analysis synonymous?
Well, I think of it as intensely related, but different things. The business model, the way I think of it, is more about all the strategic decisions, and it's more about how you do it and the details around, okay, so you're going to do internet advertising. Well, what internet advertising are you going to do? And goes into a lot of detail on that sort of thing. And has much more narrative, doesn't have to be a huge amount more, but it's really focused on strategy. And then the financial model comes from that and makes it about the dollars. And the cash flow is an integral part of the financial model, because that is that's your survival. You know, lots of businesses fail not because it's not a good idea, but because they don't have enough cash to pay their bills. And growth capital goes out the door first. You don't get paid till later.
Makes sense. Another question from Brandon. If you have a lot of different markets to choose from on your initial market for product sales model, do you recommend creating a business model for each market?
So what I'm thinking the question is asking sort of is if you have different kinds of products. Let's say you have a product and then you have a SaaS overlay that you buy the product, but you need the app in order to use it. That's a hybrid model, and lots of companies are hybrid models. So I keep them all in one model, but I keep them on different sheets. So I would have, and that's what I did basically in this. I have a product sheet and I have a SaaS sheet. If you have multiple products that behave completely differently, let's say you have a little thing that you sell to a lot of people and a big thing you sell to a few people, I would make each product its own page and then have a page that combines them.
Relating to that, what if it's the same product but a different niche target markets you could start in?
Well, then there becomes a stylistic question. And how is it going to be clearest to you? One way to do it is to say, here's channel number 1 and the distribution through that channel. And here's number 2 down below. And here's the total at the bottom. Another way would be, depending on how big they are and how complicated the economics are, product 1, product 2. And yes, they're the same product, but they behave differently. So you're capturing the different behavior on the 2 tabs.
All right. We're still waiting for a few more questions, if there are any.
Come on, guys.
I know. Well, all right. Brendan says thank you, by the way. Well, okay. Well, I guess we're gonna call it a wrap up here.
Yeah, so just to kind of like wrap it up, you're going to have different pieces of your business, each one, things that behave differently. I put on their own tab because otherwise you go into it and like, where did I put that? What's, you know, and it's easier for me and for other people to find what I'm looking for. And I put it together and I play with it. And first I build it with no numbers, with no real numbers. I just build it with dummy numbers because I know that whatever the number of sales rep is and the units per salesperson, for constructing the model purposes, I don't need to know that yet. All I need to know is that sales equals reps times units. And I put in some dummy numbers so that it's easy for me to check whether or not the math is working. And then, yeah, so I encourage you to play with the stuff that I send. And, you know, if you have any questions, my email is there. And I'm always happy to talk to people.
All right. Well, people are excited to have copies of your slides and your Excel sheets. Do you have your contact info in those slides, by the way?
Yes.
All right.
Let's go to, there I am. Can you see that? Well, anyway.
People will have copies.
It's the last page of the presentation. It has all my contact stuff.
Awesome. Well, sign up or let's see. Well, people in the chat, please fill out the survey that is towards the top of the chat. and we'll get those Excel sheets and presentation slides to you. But for now, that's all we have time for. Thank you for joining us today, and a big thank you to Kathleen for sharing her wisdom to the group.
Thanks, everyone.
Yeah, thank you. As a reminder, next Friday at noon, we'll be hearing from Lean Kawas, CEO of Athera Pharma, and she will present The Long Run, Creating a Life Science Startup. Sign up for that, and we'll see you next week. Thanks, everybody.
Bye.